Hello, this is Dr. Charles Conrick. Please call me Charles. And this is session one of the training for our spreadsheet that will help us to compute probabilities using the crystal ball function, crystal ball program, the add-in for Microsoft Excel. If you have not done so, please go back and watch the tape on how to download Crystal Ball and get it properly installed on your computer, and we'll be able to proceed. After that, I need you to go to the weeklyoptionsadvice.com's website. Under Resources, click on the button that says Resources, and you'll notice that there at the very top we have the model for the crystal ball spreadsheet, where I'm reverse highlighting the wording there, and it says download here. So just click download here, and that'll allow you to download the spreadsheet that I'll be demonstrating here today. Now, of course, you need crystal ball with that, but this is the spreadsheet. In other words, where I'm clicking with the mouse and playing with the mouse right now. This is the spreadsheet that you need for us to be playing with on the crystal ball. I also gave you a non-crystal ball function where you can hit the F9 key repeatedly or click on one of the large spinner buttons. However, it's only a model in the sense that you can use it to basically play around with. I want you to get the top one with crystal ball in order to make full functional use of the tasks we'll be learning here today. And we'll cover the historical data spreadsheet at another lesson, so that's coming. Feel free to download it if you wish, but we'll be covering that in a maybe even lesson 2 here, or whatever we want to call it, lessons. I'd rather keep these tapes informal than formal, and just share with you the things that I'm doing so that you can use them yourself to your best advantage on how you want to play with the spreadsheet and with crystal ball. That's the purpose of the entire program. So this is where you get the spreadsheet. Go to the website, under Resources, click on Download here. That'll get you the spreadsheet. Please go back and watch the 10-minute tape on how to get crystal ball, get that up and running, and we'll be in business. So I'm going to shut this down for now. And this spreadsheet consists of 5 tabs, which are described in the book. And these video demonstrations, my hope is to pretty much train you, and this is a work in progress constantly. This is it's taken a lot of time to get this far, and we'll be going a lot further. So those of you that find this of interest to you as a style and as a trading tool mechanism, I look to have a long, happy friendship and relationship with you, and I certainly hope this is of use to you. So with that said, let's get to work. The spreadsheet consists, and I'm down here, you should be able to see my cursor highlighted in a yellow tab, or yellow circle rather. This spreadsheet consists of the net sheet. Now click on it, and I'm going to come back and just visit. This purpose of this particular tape is simply to walk through, all right, what is this thing doing? That's tab 1. Tab 2 is option sheet 1, or option 1. Tab 3 is option 2 sheet. Tab 3, or 4 rather, is option 3. And tab 5, and finally, is option 4. So you've got net, option 1, option 2, option 3, option 4. Those are the 5 worksheets, and they work all individually and at the same time collectively to derive a result set out in the book, and then subsequently to use crystal ball. So you'll notice, for example, up here at the top, I'm on the crystal ball tab, and I'm going to cover crystal ball, and it'll depend upon you, the audience, how much you want me to to actually get into detail on teaching crystal ball, perhaps the best book I've ever seen is a Wiley book put out by John Charnes. You might want to go on Amazon and do a look for John Charnes' book on financial modeling with crystal ball. And it's a great, excellent book for teaching crystal ball and its many uses. So I'm going to focus more on what I've accomplished, but along the way, I'll actually be teaching crystal ball also, and then you can play with this or make up your own spreadsheets as you desire. Now, I purposely designed this spreadsheet to be 4 options. So what I'd like to do is go back to tab option 1, so that's down here at the bottom, and get it centered here so that you can see everything. And that was not what I wanted to do, but we'll get it fixed here in a minute. This tab option 1 sheet that we're looking at right now, you can see down here at the lower left hand corner where I'm playing with the yellow cursor, I'm on tab option 1. And up at the top in cell A1, right up in here, pardon me if I move the cursor too fast, I'll try to go in eye speed, but I'm up here at the top, cell A1, where it says long put, and then it says in the next column GBM, which means geometric Brownian motion model. The purpose of this sheet is simply to, well, let's put it this way. This is the primary area where you will enter your data input for whatever it is you're trading. For example, being date sensitive, today is November 17th, 2013. I'll try to tab date, or I'll try to date these. So as we grow, we'll also have a date history of what we've done. And I fully expect to be developing these more and more over the next year or two and get them down to more of a science. And I'm quite confident that many of you readers and users are much more facile with Excel than I am. Some won't be. I'm very good with Excel. I don't consider myself an expert, but if I'm not an expert, I'm close to it, I think. Although many people, I'm sure, could put me, no, I know, not maybe, could certainly put me to shame. But I'm very good at putting into use in a practical sense what I want to do for myself. And I think you'll see that here. So that's enough about my goodness or lack of goodness. By the way, I'm going to keep these tapes to 30 minutes, plus or minus a couple of minutes, because there's nothing more boring to me. I'm a finance professor at Dickinson State University in Western North Dakota, and I know that for all of us, there's nothing more aggravating than not knowing what the time, at least to me, I like knowing what the time's going to be on a speech or on a lecture. So I'm going to keep these at 30 minutes. That'll be enough, and whatever chunks we can put in and the information I can get in 30 minutes is what we'll do. And then the next section will be, I'm going to kind of have this syllabus on the fly is what I'm suggesting. So let me explain these cells to you. Over in cell B, or A5 rather, which is right here, A5, it says days to expiry. And this particular spreadsheet is made primarily for option trading. I should point out to you, this sheet will evaluate a long put, which gives you, of course, the right to sell. So I'm assuming that you have at least a basic understanding of option trading. A long put gives you the right to sell. You would buy or go long a put when you think an asset is going to go down. And I'm using approximate, I'm going to use the SPY, Sierra Papa Yankee, ticker symbol for Standard & Poor's Index. That's mainly the trade I use because it's the most liquid of all the assets. And I'm going to set up a couple of scenarios, but I've got to describe the cells to you first. So days to expiry is right here. You can change the days to expiry by tenths of a day with this spinner button right here. Click the up for more, and decrease would be, of course, the down button. Clearly what I've done is relate days to expiry to the cell next to it. So if I wanted to put in 30 days, I could just type 300 here, and that would give me 30 days. And if I wanted to put in 60 days, this would be 600. So this allows you to quickly, you can just type in this cell, quickly change the days to expiry, and then you can increment it with the spinner by a smaller amount of days. So if we're trading on weeklies, we would trade, say, put in a 50 for 5 days, 70 for 7 days, and so forth. Days of analysis. That's interesting. Where's my spinner for days of analysis? I don't see a spinner for days of analysis, and I don't know why, quite candidly. But I don't want to pause the tape right now. Suffice it to say that the days of analysis will not always, but generally match the days of days to expiry. But this spreadsheet will work. Like if you put in 30 days here, and you put this in at 20 days, like so, you'll see that it computes from today's date right here to the computed days out. Well, as an example, the next expiry day on the monthlies is December 20th, so we'd actually have to have, just to give you an idea, if I made this 40 days and I made this 40 days, bear with me a second, take 30. Okay, now that shows December 20th expiry with 40 days, excuse me, we got 40 days to expiry, and this shows the days of analysis. What I'm trying to get across to you is that you could set it up like that, and then the stock prices, which are, I took a large sample size, about 395 data points, and this model then computes the geometric Brownian motion approximation of a stock price based upon a certain number of assumptions. So, all right, reviewing section 1, this is your days to expiry, right there, and this is your days of analysis, right there. When they match up, then you're trading effectively, let's say, a weekly spread. In other words, days to expiry being next Friday, which is November the 22nd, equals today, or first thing tomorrow. All right, so let's get that in your mind, and of course, as we go through this tape and others, you'll get a much clearer understanding of exactly what I'm talking about as you begin to see more and more how this thing works and interrelates. So I just want to get through the various cells. Annual return, also controlled by a spinner up here in increments of just 1%. That's where you can put in what you think is going to happen on an annual basis for a particular asset. So again, dealing with SPY, let's say I think it's going to go up 10% annually this year. What I could do is just change that to be 10%. And what that's going to do is, of course, affect the Monte Carlo simulation of what the predicted prices will be. Effectively, as an example, if I put in 12% up here, that's about 1% a month. So one would expect then that over a 1 month period, you'd probably have an expected mean of about 1% higher than the base price. Generally for weeklies, I leave this at 0 because I have no idea what it's going to do during a given week. And an annual return of, say, even of 12% annually is 1% a month. Well, that's about 1/4% in a week. So it's very tough to predict that. So for weeklies, I generally leave that just at 0. Cell C2 right here is I call historic volatility. Now that is the most critically important thing, and I'm continuing work on that constantly, trying to find the best ways to estimate that. That is the absolute key to me to spread trading. Most people, or many people, and there's a good section I think in the book about that. In fact, I'd like to keep the little book logo up there for you so you can know where you're at, and I can know where I'm at. Yeah, a little advertising too. Historical volatility is effectively what we project over the life of the trade. The volatility is actually going to be of the stock price. Now, we don't know what it's going to be. Possibly best estimated by VIX, V-I-X, the VIX fear indicator, perhaps VXO, which is an older index. Most people tend to use the VIX, the VIX. Today, again, November 7th, 2013, and the VIX is at about 12.5%. round numbers. If you look at the VIX, it's about 12 and a half, implying a 12.5% annual, keep in mind, annual volatility. So what's it going to be next week? And that's where prices are going to actually wind up on a stock trade. So if I played with this ticker symbol, I see every time I play with the ticker, it knocks out the logo. I have to figure that one out. At any rate, if you think that the annual volatility is going to be equal to the VIX, let's say at 12.5%, what you would do would be to type in or click in historical volatility. That's just what I've got at 12.5%. Now, the most recent close on the SPY was at 180. So we can either go to cell E3 or we can click on this spinner and put the stock price. Right here you can see I'm setting the stock price at, I'll set it at 180 even. That was Friday's close. Excuse me, got a little frog in my throat. All right, so I go in increments of 10 cents. That's the current price on the stock, the S&P. Now, if we set the historical volatility to 12.5%, you might notice this pink cell. Well, that's the volatility of the volatility. I call it volatility squared in the book. That means how much is the annual volatility going to change during the given week. Generally, this is at about 50% as a rule of thumb, and we're going to cover all these details as we move along in these tape series. I'll show you a lot of data that I've collected, but generally speaking, it's at about 50%. On a very calm week, it might be far less, it might be far more. But I've got this program such that Crystal Ball will actually take the volatility into account. And it's that volatility that controls the leptokurtosis, which I mentioned in the book, which is the peakedness of the spread trade. And now this is subject to much academic study. It's something I hope to share with some of you perhaps in the future, but this is where we can set it. Generally, I set it at about the nearest 50% increment and or play with it as the market goes along. Now, the next tab would be implied volatility, but implied volatility, the only reason that that's here for this particular trade is going to be to control the price of the put, which is going to be a function of the strike price. Now, where do we want to trade? And you'll notice down where it says strike, which is right here, and at SDs away, that's an automatic computation for you of how many standard deviations you are away, given what you've put in as the stock price and the historic volatility. So the computation mathematically, if you will, I'm trying to show it to you here, just give me one moment while I find out where in the devil I put it. Well, let's never mind it for right now. We're going to be visiting all this stuff in the tape. What I'm trying to tell you is that if you want to go with an at-the-money, let's say you wanted to go with an at-the-money put, which would be at 180, you'll notice that you are 0 standard deviations away, which is intuitively exactly what you'd expect. If you went with an in-the-money put, you would be a negative X amount of standard deviations away. If you wanted to go with a standard deviation of, for example, 2, you would get this as close as you can. That automatically tells you that 173.50, the strike price of 173.50. Let me get this a little larger for you. It just dawned on me I'm making you squint all the time, and you certainly don't need to be. I beg your pardon for that. 173.50 right here. That's 2 standard deviations away, given what you've put in for historical volatility. So if you lowered the historical volatility to, say, 12, you'll notice that the SDs away has subsequently changed. At the 12.5, you're only 2.05 standard deviations away if you stay at 173.50. And as the historic volatility declines, you're actually getting further away between 180 and 173.50, which only makes sense. If you bring this down, in other words, if the asset, I don't know why I'm having this frog in my throat, if the historical volatility is only going to be, when I say only going to be, I mean we're looking for pretending what is next Friday, what is historical volatility going to be as of next Friday? We're basically doing the future and trying to predict history. If we knew that, well, then we'd all just put it down our trades and we wouldn't have to bother with all this stuff. But given that it's 12%, what I'm suggesting to you is that, okay, if you're right that it's going to have been 12.5% rather, you are now 2.05 standard deviations away for your long put. The implied volatility, getting back to that, controls then the opening put price, which is down here. So coming from down here, trying to move the cursor a little more slowly. This being the put spreadsheet, what I'm suggesting to you is that if you go onto the open market and see that this price is trading at, say, 7 cents, you need to change the implied volatility until you get the first yellow highlighted cell at 7 cents, because that will be the implied volatility. The market prices these calls and puts. You all know that. And depending upon, I'll be having an email link set up or a blog on this website very, very soon. You can email me or blog your ideas. What I'm suggesting to you is that if the market's trading this at 7 cents, you're basically looking at the volatility smile. But what you can do is match the price, and what you must do. If this was trading at 5 cents, you'd have to lower the implied volatility to a range to where this first sell was at 5 cents. Now that's gonna marry up the market interpretation and still keep you at, remember, with historic volatility here, you're actually predicting what historical volatility will be. The market's telling you what implied volatility. You have no control over that. You can read it off the trade sites, but you have no control. So let's say the price was 7 cents. What you're going to do is go in here and change this to a 7. And I usually, you'll notice that it stays 7 a long time. I go in the middle of the range. Because what this cell is doing, let me just show you the computation. What this cell is doing is using the Black-Scholes model. This whole spreadsheet is using the Black-Scholes model to give us an estimate on what everything should be, given the Black-Scholes model. So effectively, what we're trying to do is estimate what the option prices will be, but we can't control implied volatility because the market actually controls that. We all know that. All right, interest rate. Right now, interest rates for borrowed money is virtually nothing. I set it at 0.5%. Effectively, you can't. I don't want you setting it to 0, but even if you want to go down to 0.1% right now, it's not a real feature. Strike price, I've already told you. You set the strike price in increments of 50 for the SPY or increments of $1 for many other options and so forth. Time will be computed for you by whatever you put in for the days to expiry. So the pricing of this is actually going to be put based upon what you put in up here, days to expiry, not days of analysis down here. Okay. Over here, you might notice that I've given you just a computer if you want to see what the actual SD is away, for example, 173.50. If you just hold on your mouse, you'll see that 170.50 indeed corresponds to 2.05, and the same thing with the upper one if you wanted to see how far away the SD, well, that's actually a positive, excuse me. Let's bring this down to I wanted to get this down to, well, this is greater than. If I brought this down to 180, it's going to come down to a negative, obviously. So bringing it down to 180, you'll see what I mean. There, the SDs away, your 2 point, that gives you the range of the SDs all the way to the asset price. So if you wanted to get in a greater, this is giving you, for example, just let me get it up to 1 standard deviation, and what you'll see what I'm saying. This is telling you that the price 183.17, or alternatively 183 even, is actually 1 standard deviation greater than the price. So 183 is 1 standard deviation greater. 173.50 is 2 standard deviations lower. And if we shifted this up to 2, just bear with me a second while I play with this. If we shifted this up to 2, what's going to happen is that I can honestly tell you that it looks like if you were at 186.50, you'd be 2 standard deviations both below, less than, and 2 standard deviations greater than. So it's just a computer. It has nothing to do with the internal machinations of the spreadsheet itself. Now, on the long put, on tab option 1, this is basically your control panel for setting the strike price, the annual return, implied volatility for the long put, the interest rate, and so it's kind of like the master sheet for the analysis. The other sheets, tab option 2, this is just a short put. The only thing you're going to control here will be the strike price on the short put. So I've colored everything else in like an orange color. So I think we were 173.50. So if we went at 174.50, and let's say the price was 10 cents, the implied volatility on the strike would be 17.3%, which marries up with the beginning short put price. Everything else covered in orange is not available to you, and the reason I did that is because I used tab option 1 to be the setup page for the entire trading spreadsheet. Tab option 3 is the same basic deal. I'll make this a little larger since we're getting used to it, or getting near the end of the tape. This is on a short call pricing, so you'll notice here's the short call. If we set the strike price over the stock price, let's say at 186.50, for example, you'll notice that a short call would be at 7 cents if the implied volatility. So you have control of everything colored in yellow, but there is no control of the orange colored cells or dark brown or whatever color that is. You can still, no, you can't even play with them. These are all, everything is grayed out effectively except for the pricing. And then finally, tab option 4 is your long call. So you've covered the gamut of the 4 different options, building blocks on this one spreadsheet. Again, you can control the strike. So I'll shift it up to, let's say 186.50. And then the implied volatility controls the pricing. So that's all you have control over on tab options 2, 3, 4, and 1. So real quick, kind of getting ready to close this session out, let's do a review. On tab option 1 sheet, we have all of our controls for setting days to expiry. We can set the days of analysis, which generally on weekly trades will be the same thing. We can set the annual return. This is a key cell here. What is our historical volatility estimate for the given week? If you want to use VIX, then you would just type in whatever VIX is. Price here means what is the asset valued at as of the current moment, or the beginning of day or close. Implied volatility will control the price of whatever is down here, in this case the long put. Interest rate is a feeder for the Black-Scholes model. As I suggested right now, it's of little consequence, or little effect, I should say, but I want you to be aware of it. You can drop it all the way down to 0.1%, but I usually leave it at 0.5 just to be on the safe side. Here's where you'll set your strike price for the long put. Keep in mind they're all high. It tells you right at the very top left cell, what are you discussing here? You need to set the strike. And this will also tell you how many standard deviations you are away. This is a calculator to at least give you an indicator quickly of how many standard deviations you are away from either less than or above the stock price. Has no real effect, interestingly, though, on the spreadsheet's functioning. It's just a calculator for you. And then in the pink cell here, which you can operate by this spinner, that sets the volatility of the volatility. In other words, how much is this going to wiggle around? Is it just going to be a constant 12.5%, or is it going to be 18% and then down to 6% and averaging at 12%? And that'll have an effect on the peakedness of the curve. Tab option 2 just controls the short put. and you can see that by clicking on the spinner. And then you can set the price, which is down here, with the spinner on the implied volatility. Everything else is grayed out to you. Tab option 3 does the same thing for a short call. In this case, I set it at 186.50, and then you have to use look at the market chain, the option chain, and catch the implied volatility to set the price. And then the last sheet, tab option 4, controls the long call, set your strike price, whatever it might be. So here I'm at 186.50. Let's go $1 higher, 187.50. And let's say it's trading at 4 cents. So you'd bring the implied volatility to where this first sell is in the mid-range of 4 cents. All right, so those are the controls for the sheet. And I think what I'll do is stop the lesson now. And for lesson 2, we'll begin with a discussion of the net portion of the sheet, which effectively gathers the information from the previous, all the sheets we just put in. And I'll just show you, one at a time, you can actually see, let me slide over to this area. You can actually see what would happen on a given trade, one at a time. What we have in here is an iron condor, and effectively we're seeing losses, gains, and so forth just one at a time. Whereas if we use Crystal Ball, this is set up such that, and I'll just show that and then I'll close the session out. Crystal Ball will actually do this 2,000 times in a rapid simulation, which you're seeing right in front of your screen, and then give you a good estimate based upon your data of what's your percentage of breaking even on this trade. You can see I've got it set from 0 to the maximum amount, and I'm reading down here where it says certainty. This trade should, if our assumptions are right, this trade should break even at least 93% of the time. So that gives you at least a good estimate on your probability for this trade. All right, so this was lesson 1. This is Charles Conrick. Charles, I hope we can just get to know each other as Charles and fellow colleagues. The book is Vertical Option Spreads, a study of the 1.8 standard deviation inflection point. The website is available right here. This is Wiley's, the publisher was Wiley. And I really hope that you enjoy and get a lot out of these tapes, and that as we move together, and this is the website here, we can, as I said, this website is going to grow. There'll be a link for videos by the time you see this, and I'll be posting these videos probably one per week, and the library will grow as my research continues. Also, I'll be doing what's promised in the book, the back of the book, about the weekly trades, and hopefully we can set up a good blog and communicate that way. So thank you very much. Let me close session 1 out, and we'll see you for session 2 to go over, keep going over the trade spreadsheet.